Alright guys, it's the 1st of July and welcome to another market update for the beginning of this month. Now we are halfway through the year and it's been a rough year for many people. And if you feel that the decline this year has been larger than usual, you are not wrong, you are not alone. So let's take a look at this decline in context. So first of all, let's look at the S&P 500. Let's take a look at the charts and then we'll go over some fundamentals and we'll go back to the technicals again. So if you take a look at the daily time frame, you can see that we are clearly on a downtrend, right? So we entered a bear market on the S&P, we remain in a bear market, and you can see this clear downtrending channel. So in the short term, you can see that we are likely to hit lower until we see a reversal of the trend. If you take a look at the weekly candles to get a different perspective, right? So far, we have actually dropped all the way down to 24% from the peak. Since then, we have rallied off those oversold levels, but we remain about 21% below the peak. Now you can see I've marked out some of these levels over here, all right? So that's 25%. We touched that, well, we almost touched that before that rally, but we could revisit that level again. I drew a 28% from peak level because that is also a strong level of support that could be tested. And of course, I put a 35% from peak level because if you look at all the bear markets of the last 50 years, the average decline of a bear market is 35%, although I still don't see that happening in this case, but I'll just mark that in. So again, for the first half of the year, we are down a total of 24%. And right now, after the rally, we're down 21%. And that is actually really huge if you put it in historical context. Why? Well, let's take a look at this. You can see that, again, we are down currently 20.6% for the first half of the year. This is the biggest half-year decline since 1970. So I think for most of you in your lifetime, you would never have seen a decline of this magnitude. Okay, the last time it happened was 1970, and of course, even bigger than that was 1940, 1962, and 1932. Well, the bullish news is that, remember, the market is like a rubber band. When you stretch it too fast or too much in one direction, it would always tend to snap back. We call that the reversion to the mean. You can see that in all those instances, when the market dropped more than 20% in the first 6 months, in the following 6 months, you had a pretty significant rally. So the market rallied back 53% over here, 20% over here, 7.4% over here, 25% in 1970, which was the most recent time it dropped 20% in the first half, and 15.5% in 1939. So in 2022, we don't know what's going to happen in the next 6 months. But if history is anything to go by, I still think we're going to have a huge rally, a double-digit rally in the next 6 months, purely because we are really oversold. All right, you can see that in previous years, there have been declines that continued in the next 6 months, but these were a lot smaller than 20% declines. So, what's causing this really big decline in the first 6 months? Ultimately, it's inflation. All right, so we've got this sky-high inflation, and because of that, a lot of people think that the Federal Reserve has no choice but to raise interest rates and to tighten the monetary system until it forces a hard landing. It forces a big recession. So the market has declined so much because it is kind of like pricing in this worst case scenario that we're going to go into really big recession. Okay, so if you look at the headline news, what do you see almost every other day? You see recession talk in the media. And what's really interesting is this, that half the people say that we are not in a recession yet, and the other half says that we are already in a recession. Okay, like for example, this was just 2 days ago. Kathy Wood says US is already in a recession, and of course there are a few other people who say that as well. But then the New York Fed president said US recession is not my base case. So why? why can't people agree? Are we in a recession or are we not in a recession? Why can't they agree on something so simple? And the reason why no one can agree is because, first of all, the definition of recession is also different for different people. And also because, in a way, there are a lot of conflicting economic indicators. Half of which are saying that, hey, there's no recession. But the other half saying that, hey, it looks like we are going to go into recession. All right, so I'm going to go through all these things with you and you can make up your own mind. And I'll tell you what's my conclusion to all this, okay? So first of all, it's kind of like boxing. If you watch boxing, you know what's a knockout. You knock the guy out and the guy's out cold, right? But there's also what we call a technical knockout, where you don't really knock him out, but the ref says that he can't continue anymore, so it's like a knockout. So it's like a technical knockout. So it's kind of like the same way in a recession, where right now we could be entering a technical recession, right? Textbook technical recession, but it's actually not a recession, right? So right, what do I mean, right? So a lot of people, they think or they define a recession as 2 consecutive quarters of negative GDP growth. They think, okay, as long as we've got 2 quarters of negative GDP, that's a recession. That's the technical definition. But the NBER, the National Bureau of Economic Research, which is the official body that declares recessions, has already said that, hey, the 2 consecutive quarters of GDP decline is not how we define it anymore. All right. So what they're saying is this, that to declare a recession, you've got to really knock the economy out, and not just because the ref says so. Okay. So according to them, they say that a recession is defined as you got to have a decline in economic activity spread across the economy, lasting more than a few months, where you have a big drop in GDP, income, employment, industrial production, and wholesale retail sales, which there isn't right now. Does this make sense? So let me dive into that a bit deeper. So if you look at the technical definition, yes, we could be in a technical recession. Why? The first quarter of GDP came in minus 1.4%. So we are yet to see the second quarter GDP. It's not out yet, okay? But based on the Atlanta Fed GDP now, that kind of like updates in real time their forecast, their latest update, which is 30th of June, which is yesterday, they are now saying that second quarter GDP, as of now, looks to be minus 1%. So that gives us 2 quarters of negative GDP, hence a recession. By the way, this is not official. It is just their estimate. This changes every other week, right? But for now, it looks like, hey, based on that, recession. And that's why half the people are saying that we are already in a recession, okay? But again, is it a real recession where you see people losing jobs, people's income declining, economic activity contracting? Not really. Well, at least not yet. It could happen, but at least not yet. Why? Well, first of all, take a look at the unemployment rate. So you can see that historically, before a recession, which is the shaded area over here, unemployment rate would rise to at least like 4.88%, 5.6%, 4.6, 4.7% before a recession actually started. Okay, and right now the unemployment rate in the US is 3.6%, and the latest data that came out, I think 2 days ago, on unemployment claims actually dropped, which means that employment is still strong. Okay, so based on that, it's like, all right, the ref may say that he's a technical knockout, but the economy is still standing. He's not wobbly yet, okay? The next thing that's also interesting is if you look at US households, how much debt they have versus how much cash they have. Currently, US households have net 2.7 trillion of cash. So they are net not in debt, they are net in cash. Now, if you compare this to the past, for example, back in the financial crisis of 2008, a lot of people are saying, hey, could this be the 2008 financial crisis all over again? Very, very, very unlikely. Why? Because at that time, households were in debt. They had more debt than cash. Or during the dot-com crash, dot-com bubble, it was the same thing. But right now, it's a very different situation. Households are net cash and not net debt. And the same thing goes with corporations and banks. Back then, banks were highly leveraged. Companies were highly leveraged. In other words, they owed a lot more than they had. But nowadays, corporate balance sheets are very strong. Relatively, they've got a lot more cash and assets than debt. So in other words, the economy, households and corporations are a lot stronger than they were during the last two major recessions. Next, if you take a look at leading economic indicators, two of them would be payroll employment, truck transportation, and payroll employment, temp help services. So these are different facets of payroll employment. And you can see that as of the last report, it is still rising. Okay. Now you can see that again before previous recessions. Recessions are the shaded areas here. What happened to these leading indicators? They turned down. They turned down. Okay. Now look at this leading indicator over there. Right. Turn down, recession. Turn down, recession. Turn down, recession. Turn down, recession. It always turns down before recession. But for now, you can see the leading indicator over there, which is a combination of many other indicators. Yes, it's dipping a bit, but you don't see that drop. Well, at least not yet, right? So based on leading indicators, again, the economy still looks strong. I've mentioned this in my last report and my video last week that again, you can see that this is from the Philly Fed State Coincidence Index. So this shows you the number of states in the US expanding versus contracting. And historically, a US recession, before a US recession started, there needed to have at least 5 states out of 50 states showing declining activity for at least 7 months. So currently, what's the latest report? This is the latest report dated 29 June, which is 2 days ago. And it says that over the past 3 months, the indexes increased in all 50 states. So in other words, all 50 states showed economic increase for a 3-month diffusion index of 100. Now in the last 1 month, the indexes increased in 44 states, decreased in 3 states, and remained stable in 3 states. So in other words, out of the 50 states, there were 3 states that declined. Okay, so we've got 3 out of 50 declining. We need at least 5 to decline for at least 7 months. In this case, only 3 has declined for 1 month. So sure, we could have a recession based on this broader term, but it's not happening, at least not yet. All right, I know some of you are probably thinking, Adam, I don't really care about the definition. All I want to know is how much lower can the stock market go, all right? Okay, so let's take a look at this chart. And this chart shows you the S&P 500 index and versus the PMI readings. So PMI is the Purchasing Managers Index, which is a way to gauge economic activity. Now, if you take a look at history, you can see that the stock price of the market and the PMI, they very much move together. So the red one is the S&P 500, and on the left shows you the percentage change. On the right, the blue line is the PMI, which again measures economic activity. Now remember, I've said this before that the stock market has dropped, but the economy is not really in a recession, right? So why? Because the stock market tends to price in a recession even before it has happened. Now, let's take a look at what this means. So currently you can see that the S&P 500, which is the red line, it has already dropped. Okay, it has already dropped. The market has already dropped, but the economy has not yet come down. So the market is already pricing in that so-called recession that has not yet happened. Now, currently, the manufacturing PMI is at 56 points. Anything below 50 points is a contraction, okay? So if it drops from 56 to 52 to 50, yes, the economy is slowing, but it's not really contracting, okay? Now, at the end of the day, the blue line and the red line will always meet. They will always eventually catch up to one another, okay? So right now, the market has gone down already. So in order to justify the market going down, the economy has to drop from 56 to 48. Has that happened yet? It has not happened yet, right? So what I'm saying is this: the market has really priced in the drop from 56 to 48. So if the economy actually drops from 56 to 48, then the market won't go down further, because the market's like, okay, I've done my job, all right? And then the market will rebound from there, because the market always looks 6 months ahead. Now let's look at all the different scenarios. Now the first scenario is this. So this is the S&P 500. The first scenario is that for the next 6 months, the market rebounds back to the highs. Now, some of you are probably thinking, Adam, are you too optimistic? Are you sure that could happen by the end of the year? Well, we never know, right? But anyway, let's call that scenario number one, shall we? So scenario number one means that by the end of the year, the S&P had a 0% change. 0% change for the whole year. Okay, that is scenario number one. Scenario number two is that the S&P for the next 6 months remains where it is right now. So it goes up, down, up, down, up, down, up, down, up, down. At the end of the 6 months, it is where it is right now. Okay, which is roughly down about, well, let's take this low here, right? Down roughly about 25%. Okay, so let's call that scenario number two. Scenario number three is what a lot of the biggest bears are saying. They're saying, this is going to be like 1970. This is going to be like the financial crisis. We're going to, drop at least down 35%, which is the average bear market low. So if you take a 35% drop, that is roughly, let's take a look. If you take a 35% drop from the high, whoa, 35%, it's about there. Somewhere here. Okay, at about 3150, this would be a 35% drop. So this is scenario number three. Okay, so let's take a look. What must happen to the economy in order for the market to drop to this level, or for the market to stay at this level? All right, so let's go back and look at the PMI and see what has to happen for this to play out. Okay, so scenario number one is the most optimistic, which means the market rebounds back to the all-time highs of the start of the year, and we end up 0% gain for the whole of 2022, right? Okay, so this is what we call scenario number one. So for scenario number one to happen, the economy has to decline from 56 PMI, which is where we are now, all the way down to 50 PMI. So in other words, even if the economy declines, right, from 56, or rather economic activity declines from 56 to 50, we should rally all the way back to the new all-time highs by the end of the year. Why? Because the market has already priced it in a way, right? Now, how about scenario number two? Scenario number two is that the market stays where it is right now. Okay, scenario number two is that the market remains at where it is right now, which is roughly about 24-25% from the highs, okay, which is here, this level, right, this 25% decline. Now, for this to play out, that means that the PMI has to drop all the way down to 42 level. Now, for it to drop to 42 level, that means the economy has to contract as badly as during the dot-com crash. So do I see that happening? I don't see that happening. Why? Because like I mentioned much earlier, companies are a lot stronger today, households are a lot stronger today, and companies are a lot more profitable today than the dot-com crash. So currently the market has gone down close to 25%. It happened a few days ago, which means we are pricing in this recession in the dot-com, which to me it's overreacted. The market's overreacted. Okay. Now, for the market to drop 35%, right? 35%, which is what a lot of the major doomsday people are saying, oh, it's going to be a big bang, it'll drop 35%. Now, for this to happen, the PMI has to drop to 38 or about 39, which means this was where it was during the great financial crisis, when a lot of banks almost went bankrupt because a lot of their assets went to zero. Again, are we in that situation right now? No. Okay, so that's why I say for the market to drop to 35%, which is what people are saying, or to even stay at 25%, for that to happen, we need to see dot-com crash and financial crisis crash scenarios, which I don't see. Yes, we are probably going to have a technical recession. We are probably going to have a recession. All right, let me put it away. We could have a recession, but even if we have a recession down to a contraction of 48, that means the market has already priced it in because we're down 25%. That means the market will rally back to, if not the all-time highs, at least 5% below the all-time highs. So my base case projection, and again, I could be wrong, right? My base case projection is that highly likely in the next 6 months, we are going to rally back to 5% below the peak. Or maybe even back to the peak, right? Which puts our entire 2022 at minus 5% or break even. And that is assuming, again, that economic activity falls from 56, where we are now, down to 48 to 50, which is what we call a mild recession or a technical recession. All right, so that's my base case. Again, I could be wrong, but that's what I'm looking at. So if you're asking me, Adam, are you still bullish for the second half? Yes, I am. Okay. Now, again, the other interesting thing is this. So we know that the market, the stock market is, the price of the market depends on earnings, right? So the higher the earnings, the higher the market, okay? So again, the stock market has dropped, 20 to 25% so far this year. But the earnings have not dropped, all right? If you look at the earnings forecast, now they have been reducing the forecast because some companies have actually lowered their guidance. So all this has been taken into account. So this is the latest as of 23rd of June, all right? Now, based on consensus forecasts, which are all the analysts out there, they see that by the end of 2022, the S&P 500 earnings per share for the 500 companies would be about $229 per share. 229, which is somewhere about there. Okay. Now, Yardeni Research, which is the one I'm following, and Yardeni tends to be a bit more conservative, right? They are projecting that the end of 2022, the earnings per share for the S&P will be 225, which is somewhere over here. So what does that mean? That means to say this year, the earnings of the companies are still projected to grow. Okay, but the market has dropped 20%, even though earnings have projected to grow. So again, the market has already declined even before earnings have declined. So if earnings do decline, then okay, maybe it's fair, right? But if earnings don't decline as much as feared, then the market has a reason to rally really strongly. This is the S&P 500 forward 12-month PE ratio. You can see that for the last 5 years, the average forward PE has been 18.6 times. And for the last 10 years, the average forward PE has been 16.9 times. So currently the market, we are trading at 15.8 times earnings. So in other words, the market is undervalued historically. It is below the historical average PE ratio. Now again, you may say, yeah, but Adam, cheap can get cheaper. True, cheap can get cheaper. So if it does get cheaper and it drops to this level here, what's the PE at that level? The PE at that level would be about 13 to 14 times earnings, right? So if you take 14 times earnings, multiply that by the forecasted EPS, which is 225, what do you get? 225 times 14, you get 3150. And 3150 would be coinciding with that 35% drop. Okay, which is our worst case scenario, which is a drop of another roughly 15% from current levels, right? Again, this is not my base case scenario, but I'm showing you what is the so-called the worst that would happen if we contract to a 14 times PE at the current EPS projections.